December 8th, 2025. Silver trading near $58 per ounce, close to all-time highs. But here's what caught my attention. While Western investors debate whether this rally continues, something else is happening. Something almost no one is discussing. China and Russia aren't just buying silver anymore. They're repositioning their entire reserve strategies around it. And if the pattern I've been studying holds, we're not watching a price rally. We're watching the early stages of a global supply crisis. This isn't about predicting the next $5 or $10 in price movement. This is about understanding a structural shift happening in real time. A shift where the world's second and 11th largest economies are systematically accumulating physical silver while global inventories drain. Let me show you exactly what's happening, why it matters, and what the data tells us about where this leads. I'm not a financial advisor. This isn't financial advice. This is purely educational analysis based on publicly available information. Make your own decisions. Let's start with what's actually happening right now, because the surface numbers don't tell the full story. Silver closed 2024 up approximately 21%. Strong performance. But dig deeper and you find something more significant. Russia made an announcement in 2024 that changed everything. For the first time in over 50 years, a major nation officially designated silver as a strategic reserve asset. The Russian Finance Ministry allocated 51 billion rubles, approximately $535 million, specifically for precious metals purchases over 2025 through 2027, not just gold, silver, platinum, and palladium. This represents a fundamental shift. Central banks abandoned silver as a monetary reserve in the mid-1800s. For 170 years, silver was industrial, investment, but not official reserves. Russia just reversed that 170-year trend. Why does this matter? Because Russia isn't operating in isolation. China holds approximately 70,000 metric tons of silver reserves in the ground. That's third globally behind Peru and Russia. But here's what's interesting. China's documented silver consumption tells a different story than their production. China produced 3,300 metric tons in 2024, but China's industrial demand, particularly for solar panels, electric vehicles, and electronics, consumes far more than they produce. According to market analysts, China now manufactures over 80% of global solar panels. Every panel requires silver paste for conductivity. Electric vehicle production in China increased 40% year over year. Every EV uses roughly twice the silver of a traditional vehicle. 5G infrastructure build-out continues accelerating. Every tower needs silver components. The math doesn't work unless China is importing massive quantities, and they are. But the real question isn't how much they're buying. The question is, why are they buying now? And why is Russia, facing Western sanctions, choosing to allocate over $500 million to silver specifically? The answer becomes clearer when you look at the supply side. The Silver Institute reported something significant in their 2025 World Silver Survey. The global silver market is heading into its fifth consecutive year of structural deficit. Let me explain what that means. In 2024, total silver demand reached approximately 1.16 billion ounces. Total supply, including mining and recycling, reached approximately 1.01 billion ounces. That's a deficit of roughly 148.9 million ounces, 1 year alone. But here's where it gets critical. From 2021 through 2024, the cumulative deficit reached 678 million ounces. That's equivalent to 10 months of global mine supply in 2024. Gone. Consumed. Not replaced. And 2025 is projected to be the fifth consecutive deficit year. The market is consuming more silver than it produces, year after year. Where's the difference coming from? Above ground stockpiles, vaults, reserves, and those are draining. COMEX registered silver, the silver available for immediate delivery against futures contracts, tells the story. In February 2021, COMEX held approximately 152 million ounces of registered silver. As of late 2024, that number dropped to approximately 73 million ounces. That's a decline of over 50% in under 4 years. London vaults show similar patterns. The London Bullion Market Association reported silver inventories fell to approximately 827 million ounces in December 2024, near all-time lows, and approximately 551 million ounces of that is reportedly allocated to ETF holdings. That leaves roughly 276 million ounces as a float. Available? Tradable. Now, combine this with industrial demand. Industrial silver demand hit a record 680.5 million ounces in 2024, fourth consecutive year of record highs. This isn't investment demand. This is silver being consumed, used, gone. Solar panels, electronics, medical applications, 5G infrastructure, AI data centers, all require silver, and demand is growing, not shrinking. Photovoltaic applications alone consumed approximately 197.6 million ounces in 2024. That's nearly 30% of all industrial demand. Solar installations doubled in 2024. Governments worldwide are pushing renewable energy mandates. That means more panels, more silver consumption, structural, ongoing, permanent demand. Here's where China and Russia enter the equation differently. They're not passive industrial consumers. They're strategic accumulators positioning ahead of a supply crisis they see coming. Russia's allocation of $535 million over 3 years for precious metals isn't random. It's calculated. Russia produces approximately 28% of global platinum. They're a major producer, yet they're buying precious metals, including silver, as strategic reserves. Why? 2 reasons. First, sanctions. The freezing of approximately $300 billion in Russian reserves in 2022 taught Moscow a permanent lesson. Dollar reserves can be seized, euros can be frozen, but physical precious metals in domestic vaults cannot be confiscated. Silver, like gold, is sanction-proof. Second, industrial strategy. Russia sees what's coming. A world electrifying, a world building 5G and 6G networks, a world dependent on silver for critical technologies. And Russia is positioning to have supply when others don't. China's strategy appears different but equally calculated. China doesn't announce silver purchases the way Russia does, but their import data tells the story. India, historically a major silver buyer, imported record quantities in 2024, but China's imports, while less publicized, show consistent accumulation patterns. Market analysts studying China's silver strategy note something interesting. From 2010 to 2022, during a period when silver prices were relatively suppressed, China may have pursued strategic accumulation similar to their well-documented gold strategy. China's official gold reserves reached 2,279.57 tons by end of 2024. That's documented. They've been buying consistently since 2015. If China employed even a fraction of that discipline with silver, given their industrial dominance and future technology needs, the accumulation would be substantial. And here's the critical part. Both nations are buying while prices are still historically reasonable, and while physical supply is still available. This is pattern recognition. History shows that strategic reserve building happens before crises, not during them. Let me show you what happens when major powers accumulate resources ahead of supply shortages. Gold provides the template. Central banks globally purchased over 1,000 tons of gold annually for 3 consecutive years, 2022, 2023, and 2024. That's unprecedented. The result? Gold prices rose from approximately $2,000 per ounce in early 2024 to pushing $4,100 in December 2025, over 100% gain. Why? Because persistent demand from entities with unlimited budgets creates a structural floor under prices. Central banks don't panic sell. They don't trade. They accumulate and hold. This removes supply from the market permanently. Now apply that logic to silver. Russia officially designating silver as strategic reserves. China consuming more than they produce. Both nations representing significant economic power, competing for limited physical supply. And they're not the only ones. According to reports, Turkey, India, Poland, and other nations increased precious metals reserves significantly in 2024. The pattern is spreading. As dollar dominance slowly erodes, as geopolitical tensions rise, as Western financial systems demonstrate, they'll weaponize access during conflicts. Nations are hedging. Physical assets, domestic vaults, diversification away from paper promises. This creates a problem for the silver market specifically. Unlike gold, where annual mine production is approximately 3,000 tons and above-ground stocks are measured in decades of supply, silver's dynamics are different. Approximately 70% of silver comes as a byproduct of other metals: copper, lead, zinc, gold mines. This means silver supply is relatively inelastic. If copper prices don't justify opening new mines, the silver that would have come as byproduct never gets produced. And copper, zinc, and lead prices in 2024 were not strong enough to drive major new mine development. Primary silver mines, those specifically targeting silver, are declining. According to data, primary silver supply fell to approximately 227.5 million ounces in 2024, continuing a long-term downward trend. The easy, high-grade silver deposits were mined decades ago. What remains requires more capital, more energy, more processing to extract less metal. Economically challenging at today's prices. Recycling should theoretically fill the gap, but silver recycling faces limitations. Electronics recycling recovers only about 18% of silver used. Solar panels lock silver away for 25 to 30 years. Industrial processes are optimizing to use less silver, not generating more recyclable waste. Recycling added approximately 193.9 million ounces in 2024. Helpful, but nowhere near enough to close a 148 million ounce deficit. So here's the situation. Structural supply deficit, 5 consecutive years. Industrial demand at records, mine supply relatively flat. Recycling insufficient, above-ground inventories draining. COMEX registered stocks down 50% since 2021. London vaults at near all-time lows. And now add in two major nations, China and Russia, systematically accumulating physical silver as strategic policy. What happens next isn't speculation. It's supply and demand mathematics. When demand persistently exceeds supply, one of three things must occur. First, price rises until demand is destroyed. Industrial users find substitutes. Solar manufacturers reduce silver content per panel. Electronics companies redesign circuits. But silver's unique properties, highest electrical conductivity of all metals, make substitution difficult. And green energy mandates mean solar demand isn't optional. It's policy-driven, structural. Second, supply increases dramatically. New mines open, production ramps up, but mining operates on 5 to 10-year timelines. Discovering a deposit, permitting, financing, constructing, ramping up production. That doesn't happen in months, it happens in years. And with silver as primarily byproduct, supply increases require base metal prices to surge first. That hasn't happened yet. Third, available inventory drains to zero. This is the critical point. Physical shortages emerge, premiums spike, delivery times extend. The paper market, futures contracts, ETFs, diverges from physical reality. We've seen this before. In 2020, during COVID, silver hit approximately $28 per ounce, but physical coins and bars were selling for $45. That's approximately a 60% premium. Paper price said 28, physical market said 45. The disconnect lasted months. Why? Because when everyone wants physical metal simultaneously, there's not enough to go around. Mints couldn't keep up. Dealers were back-ordered. Premiums exploded. That was temporary panic. Imagine what happens when the shortage is structural, when it's not panic but mathematics. 5 consecutive deficit years become 6, 7, 8. COMEX registered falls from 73 million ounces to 50 million to 30 million. At some point, the available physical supply becomes so tight that the paper market loses credibility. This is where China and Russia's timing becomes clear. They're accumulating now while physical is available, while premiums are manageable, while the market still functions normally. They're not waiting for crisis prices. They're positioning before the crisis. This is Strategic Reserve Building 101. You don't announce you're buying at the top. You accumulate quietly when no one's paying attention. Then, when supply tightens and prices move, you're already positioned. Russia's public announcement of $535 million for silver over 3 years isn't panic buying. At current prices, that's roughly 9 million ounces per year, assuming $60 per ounce average. Not enormous. But it's official. Documented, budgeted. That means they view this as long-term strategic necessity, not speculation. China's approach appears less public, but potentially larger scale. Their industrial consumption alone requires them to import hundreds of millions of ounces. If even a fraction of that is being accumulated beyond immediate industrial needs, the numbers become significant quickly. Now, let's talk about what $61 per ounce means and whether it's sustainable. Silver hit approximately $59 in early December 2025, according to recent data. That's approaching the inflation-adjusted high from 1980. Back then, the Hunt brothers drove silver to approximately $49 before the exchange changed rules and forced liquidation. Adjusted for inflation, that $49 equals roughly $170 in today's purchasing power. But here's the difference. The Hunt brothers were leveraged speculators. The exchange could change rules, force liquidation. The Hunts lost, but the shortage was real. The fundamentals were real. It took changing the entire game to stop the rally. Today's situation is different. This isn't 2 billionaires on margin. This is sovereign nations with unlimited budgets, multi-year time horizons, and strategic mandates. You can't margin call a country. You can't change exchange rules on national reserve policies. According to various analyst projections, silver targets range widely. Some suggest $75 to $90 by end of 2026. Conservative estimates, others looking at gold-silver ratios historically around 15 to 1, suggest silver could reach $280 if that ratio normalizes. Currently, the ratio sits at approximately 72 to 1. Gold near $4,200, silver near $58. Historically, silver has tracked gold. When gold moves, silver follows, but more volatile, faster, more explosive. If gold continues toward $5,000, which many analysts project, and the gold-silver ratio compresses even partially toward historical norms, silver reaches $150 to $200 mathematically. Not because of speculation, because of ratio reversion. This happens naturally over time when fundamentals align. And right now, fundamentals are misaligned. Silver is undervalued relative to gold, undervalued relative to industrial importance, undervalued relative to supply deficit reality. But the real catalyst isn't ratio reversion. The real catalyst is physical shortage becoming undeniable. When COMEX registered silver falls below 50 million ounces, the system faces stress. At current delivery rates and drain rates, that could happen within 6 to 12 months, maybe sooner if large deliveries are requested. When London vaults drain another 100 million ounces, market participants start questioning whether there's enough metal to back all the paper claims. ETFs hold approximately 820 million ounces globally, but how much of that is actually segregated, allocated, and available? These questions matter when supply is tight. The situation reminds me of the 2021 nickel squeeze on the London Metal Exchange. Nickel prices spiked 250% in 2 days because a major short position couldn't deliver physical metal. The exchange suspended trading, canceled trades, changed rules retroactively, chaos, market manipulation accusations, lawsuits. But the underlying message was clear. When paper markets face physical delivery stress, anything can happen. Rules change, confidence breaks, silver faces similar dynamics but bigger scale. The COMEX silver market has open interest representing approximately 226% of all vaulted silver. That means there are more than 2 paper claims for every ounce in vaults, and 1/802% of registered silver specifically. That's 18 paper claims for every registered ounce available for delivery. The leverage is extreme. The system works only as long as everyone doesn't ask for delivery simultaneously. What happens when China or Russia, nations with official strategic reserve policies, decide they want physical delivery against futures positions? What happens when industrial users, facing multi-year contracts, demand physical settlement rather than cash? The strain on registered silver would be immediate and severe. Premiums would spike, delivery times would extend. The disconnect between paper price and physical availability becomes the story. This is the pattern I've been studying. And it's not prediction, it's observation. The pieces are moving into position. Structural deficit, check. Inventory drain, check. Strategic accumulation by major powers, check. Industrial demand at records, check. Mine supply unable to increase rapidly, check. Every element necessary for a supply crisis exists right now. And the only question is timing. Based on historical precedent, major supply-driven price moves happen when physical shortage becomes undeniable, not when traders discuss it, when industry can't get metal, when mints ration product, when dealers have 6-month backlogs. That's the trigger. And according to data from COMEX inventory trends, London vault drains, and persistent deficits, we're closer to that trigger than most people realize. The December 2025 Federal Reserve meeting added another element. If they cut rates, as approximately 88 to 90% of markets expect, the dollar weakens. Weaker dollar historically boosts precious metals, gold and silver both. But more importantly, rate cuts signal economic concerns. Concerns drive safe haven demand. Physical assets over paper promises. This benefits silver. The geopolitical backdrop matters too. US-China tensions persist. Russia remains sanctioned and isolated from Western financial systems. Middle East remains volatile. Trade wars continue. Dollar weaponization demonstrated in 2022 with Russia's $300 billion reserve freeze taught every nation a permanent lesson. Your reserves aren't safe if they're paper promises in someone else's system. Physical assets, domestic vaults, that's real security. This is why central banks globally bought over 1,000 tons of gold for 3 consecutive years, and why Russia, becoming the first nation in 50 years to officially add silver to strategic reserves, matters. It legitimizes silver as a monetary metal again. Other nations watching may follow. Turkey, India, Saudi Arabia. Nations diversifying away from dollar dependence. Nations with industrial economies requiring silver. Nations wanting sanction-proof reserves. If even a fraction of central bank buying shifts towards silver, the way it has for gold, the impact on a market with only 1 billion ounces of annual supply would be dramatic. Gold has 200,000 tons of above-ground supply, approximately 6.4 billion ounces. Central banks buying 1,000 tons, 32 million ounces, is less than 1% of above-ground stocks. Silver has much smaller above-ground readily available supply. Central banks buying even 50 million ounces annually, less than $100 million at current prices, would be significant relative to market size. This is the asymmetry. Small amounts of capital moving into silver have outsized price impact. Because the market is much smaller than gold, much smaller than equities, much smaller than bonds, and if China and Russia are moving first, positioning while others hesitate, they're securing supply at prices that will look cheap in hindsight. So what does $61 mean? It means we're in the zone where historical resistance meets structural deficit reality. It means the market is pricing in some probability of shortage but not certainty. If shortage becomes certain, if physical becomes genuinely scarce, the repricing won't be gradual. It'll be explosive. $70, $80, $90, $100 come quickly when supply-demand dynamics break. We saw it with copper in 2020 and 2021. We saw it with palladium in 2020. We're seeing it unfold with silver now. The difference is silver sits at the intersection of precious metal and industrial critical material. It's money when people lose faith in currency. It's necessity when industry needs connectivity, reflectivity, antimicrobial properties. You can't print more. You can't substitute easily. You either have it or you don't. And increasingly, as China and Russia position strategically, as industrial demand sets records, as mines can't keep up, and as inventories drain year after year, the answer becoming clear. There's not enough. At least not at current prices. This is educational analysis based on publicly available data. Supply deficits, inventory trends, nation-state accumulation, industrial demand, mine supply constraints, all factual, all documented. The conclusion that these factors lead to higher prices is logical. Not financial advice, pattern recognition. History rhymes. And right now, history is rhyming with every major commodity shortage of the past 50 years. Early accumulation by those with information, denial by the mainstream, then shortage, then price explosion, then hindsight saying it was obvious. We're somewhere between denial and shortage. That's where the opportunity exists for those paying attention. But it's also where risk is highest for those unprepared. Understand what's happening. 5 consecutive years of deficit. China and Russia positioning, inventories draining, industrial demand surging, mine supply stuck. Everything points the same direction. And direction is more important than price. $58, $61, $70. The exact number today doesn't matter. What matters is the trajectory. And trajectory is up, structurally, persistently, until supply increases, demand falls, or price reaches levels where both happen. None of those are imminent. Supply increases take years. Demand is policy-driven green energy mandates. Price? That's the adjustment mechanism. And it's just beginning to adjust.